Welcome to the Saturday special episode of the Daily Brief, which we call the Weekly Brief. Here we give you a compilation of our favorite stories from the entire week. So hope you enjoy. Let's talk about how the Indian economy is doing. The World Bank recently published its India Development Update, and it gives us a fairly detailed overview of the Indian economy. The entire Daily Brief team read it, so you don't have to, and I thought it'll be great to summarize all the key highlights for you. Let me start with the good news first. In the fiscal year 23-24, India's GDP grew by 8.2%, which outpaced other major economies. This growth is reflected in India's financial markets as well. Indian equity markets have hit new all-time highs this year, with the total market cap of India's stock market now at around 5 trillion US dollars. India's share in the MSCI Emerging Markets Index has also grown and has reached an all-time high of 20.5%. A key driver of India's growth is government investments. The central government has increased its capital expenditure by 28%, focusing on infrastructure development. Now, this push in infrastructure, which includes roads, ports, power plants, and improved logistics, is laying the groundwork for future economic growth. In the manufacturing sector, we've seen a significant rebound. After a contraction of 2.2% in the previous year, manufacturing grew by 9.9% in FY 2023-24. This growth was supported by declining import costs, particularly due to moderation in global oil prices. The manufacturing expansion was primarily driven by sectors like construction and electronics, which benefited from both public infrastructure investments and the increasing domestic demand in the country. India's services sector, especially areas like IT and finance, continues to be a strong point for the economy. Services growth remained robust at 7.6% in FY 23-24, with modern services like IT and business services growing at about 13% annually since 2000. These sectors now account for over two-thirds of India's services exports. However, not every sector in India's economy is doing equally well. Agriculture, which remains crucial for rural livelihoods, has faced significant challenges. Agricultural growth fell to 1.4%, which is down from 4.7% in the previous year. This decline was primarily due to erratic rainfall, which shows how vulnerable this sector is to climate factors. But this year, monsoons are looking good so far, and the hope is that the growth will rebound. The agricultural slowdown has broader economic impacts, by the way. Private consumption, which drives about 60% of India's GDP, fell to 4% in FY 23-24 from 6.8% in the previous year. Now, this is partly attributable to the reduced rural incomes, which affect household spending eventually. But there was an uptick in consumption growth in the last quarter. What remains to be seen is if it was just a small blip or the start of a strong consumption rebound. But having said that, high-frequency data points like air travel, passenger vehicle sales, FMCG sales, cement consumption, etc. are indicating that rural consumption is slowing down while rural consumption is picking up. The net impact on consumption growth, however, still remains to be seen. On the inflation front, while headline inflation has moderated to an average of 5.4% in FY 23-24, food inflation remained high at 8.9% on average in Q1 FY 24-25 before dropping sharply to 5.4% in July 2024. Now, these fluctuations put pressure on household budgets, particularly for lower income families. Looking ahead, India's economic growth is projected to remain strong at 7% in FY 24-25 despite subdued external environments. Several factors contribute to this positive outlook, by the way. The significant expansion of public investments in recent years is expected to crowd in corporate investments. A recovery in agriculture and declining inflation should boost private consumption growth. Additionally, the services sector, particularly IT and business services, continues to show robust growth. But looking further ahead, India is expected to double its current annual GDP of 3.5 trillion US dollars to 7 trillion US dollars by 2030, which could potentially make it the world's third largest economy. This growth trajectory is very heavily supported by India's very favorable demographics. Our country's demographic dividend is expected to persist until at least 2055-2056 and peak around 2041 when the share of the working age population, which is 20 to 59 years, is expected to reach 59%. Moreover, the middle class is the fastest growing social segment, which is rising at 6.3% per annum since 1995 and is now representing around a third of the total population of the country. But there are still some challenges, particularly in job creation. Despite strong economic performance, the link between exports and employment has only weakened over time. The share of export related jobs has decreased from 9.5% of total domestic employment in 2012 to 6.5% in 2020. Now, this paradox of high growth and lagging job creation is partly due to the nature of India's exports. I'll explain. India's exports have increasingly shifted towards more capital intensive and skill intensive sectors. While these sectors, such as IT services, pharmaceuticals, and advanced manufacturing, contribute significantly to the economic growth, they generate fewer jobs as compared to traditional labor intensive industries. This shift explains why strong export growth has not translated into proportional employment gains in the country. The challenge for India is to diversify its export baskets to include more labor intensive sectors. Industries such as textile, apparel, leather, and footwear have traditionally been significant job creators, especially for women and also for less skilled workers. However, India's global market share in these sectors has been declining. For instance, India's share in global exports of apparel, leathers, textile, and footwear or ALTF sectors peaked at 4.5% in 2013, but since then has declined to 3.5% in 2022. Now, this brings us to an important opportunity that emerges from global supply chain shifts. As China gradually withdraws from low-skill manufacturing due to rising wages, a significant market gap is opening up. Countries like Bangladesh and Vietnam have been very quick to capitalize on this opportunity. Bangladesh's share in global ALTF exports reached 5.1% in 2022, while Vietnam's rose to 5.9%. India definitely has potential to capture a much larger share of this market, which could boost both exports and jobs in the country. But in order to seize this opportunity, we need to address many challenges. And this includes our approach to trade policy. In recent years, India has increased its use of protectionist measures. The average most favored nation tariff has risen to 18.1% in 2022, up from 13.4% in 2016. Now, this trend is not unique to India alone. It is a part of a global resurgence in protectionism. In 2023, almost 3,000 new trade distorting measures were imposed globally, 3 times as many as 2019. However, India's protectionist measures, even though are aimed at protecting domestic industries, may be hindering its integration into global value chains. India's participation in global value chains has been declining over the past decade. Specifically, the use of imported inputs in India's exports has fallen from over 25% of gross exports around 2010 to about 15% in 2020. Now, this decline in the use of foreign inputs for exports limits opportunities for technology transfer, productivity improvements, and job creation in the export-oriented sectors. Despite this growth, India remains a largely underallocated market for major emerging market portfolio managers relative to other EM countries, which suggests a potential for increased foreign investments in the future. Now, to address these challenges and capitalize on emerging opportunities, India has to do many things at the same time. First, diversifying exports into more labor-intensive sectors while continuing to support high-value skill-intensive industries. Second is reducing trade barriers, both tariff and non-tariff, in order to improve competitiveness and integration into global value chains. Third, focusing on skill development in order to prepare the workforce for both labor-intensive and high-skill jobs. Fourth, improving logistics and trade facilitation to reduce the cost of exports. Fifth, reevaluating trade agreements and regional integration options to expand market access. Now, considering how far we have already come, the hope is that India will get things right and will continue to grow at a healthy pace. Let's start where I talk about how the US Fed interest rates affect India. See, a few weeks ago, Jerome Powell, who is the head of the US Federal Reserve, dropped a hint that they might be cutting interest rates very soon. He said, and I quote, "The time has come for policy to adjust." Now, this was basically a soft signal that a Fed interest rate cut might be on the horizon. Now, fast forward to yesterday night's Fed meeting. By the time you're hearing this, they might have already made their call on interest rate cuts. Now, I've talked about Fed rate cuts and inflation quite a bit on this show by now. So I'm guessing you probably at least have a rough idea of why decisions like this are a big deal, not only for the US, but for everyone around the world, including for us here in India. So today I wanted to dig a little more deeper into what has been happening in the US and how their decisions are spilling over to affect the rest of the world, including India. See, since early 2021, inflation has been a major pain point in the US. The pandemic messed up global supply chains and made it very hard for companies to get the stuff that they needed. At the same time, the demand for goods was shooting up because businesses and people were trying to bounce back. Now, to top it off, the government pumped a lot of money into the economy in order to help things out, and this boosted spending even more. So, with high demand and low supply, prices shot up, which is classic inflation. Now, to fight this, the Fed started raising interest rates in 2022 and 2023. The idea was to make borrowing more expensive so that people as well as businesses spend less, which could hopefully cool down inflation eventually. And this seemed to have worked, but only partly. See, although inflation eased up, the other parts of the economy, like job growth, began to slow down significantly. Now, to understand why all of this happened, we must understand exactly what happens when the Fed cuts interest rates. Whenever the Fed cuts interest rates, borrowing becomes cheaper. It is as straightforward as that. For businesses, it means they can borrow money at a lower cost, which encourages them to invest and expand even further. For regular people like you and me, this means mortgages, car loans, credit card debt, etc. all get a little less expensive. So spending tends to pick up even further. And more spending gives the economy a big boost. But there is also a flip side to this, which is very relevant to us in India. See, rate cuts can weaken the US dollar, which actually works in favor of emerging markets like India. And this is because we as a country often borrow in US dollars. And the weaker the dollar gets, it makes it easier for us to pay off those debts because it effectively costs us lesser. Now, talking about this specific rate cut cycle, it is very different from the past ones like what we witnessed in the year 2000 and 2008. In the early 2000s, high levels of corporate debt, especially in the tech sector, played a very important role in the dot-com bubble crash. A big part of why this happened is because the Fed started to raise interest rates in 1999 in order to cool down the economy, which contributed to the bubble bursting. After that, the Fed started cutting rates in order to stabilize the markets. In 2008, it was housing debt that led to the financial crisis. Years of low rates had fueled massive borrowing in the housing market, especially subprime mortgages. When that bubble burst, the Fed responded by slashing rates aggressively in order to prevent a complete economic collapse. But today, 2024 is very different. US households and businesses are not carrying as much debt as they were in those previous cycles. Household debt, particularly mortgage debt, is much more manageable and businesses are not as highly leveraged as they were in 2000. And this is why this cycle feels so different. Even if the Fed cuts interest rates today, we are no more dealing with the same financial imbalances that we used to in the past. But that said, the biggest and the most important question for us as Indians is, how does all of this even affect India? See, India's central bank, which is the RBI, usually monitors the Fed's actions very closely. While they set rates based on the country's economic performance, there is also a ripple effect in the picture. So whenever the Fed cuts or raises interest rates, the RBI mostly tends to follow it. This impacts Indian markets, including things like stocks, bonds, and even the Indian rupee. All these instruments react very strongly to changes in the US monetary policy. So if Fed cuts interest rates, Indian asset classes, especially sectors that depend on global capital flows, also tend to witness a positive boost and vice versa. But as a conclusion, even though it is very tempting to look at past rate cuts for clues of what the future would look like, the global economy today is very different from how it has ever been in the past. As I already mentioned, there is less private debt in the US, inflation is structurally higher, and we are still dealing with the aftermath of the pandemic. Predicting how the markets will react to this rate cycle is very tricky. I'll talk about why the government is suddenly so interested in quick commerce. See, as we all might already know, quick commerce is very quickly becoming a big part of how we shop these days. In fact, the space has grown so quickly that today quick commerce makes up about 5 to 6% of what households spend on grocery, according to estimates cited by Economic Times. Now, this growth is not only changing the way we shop, it is also catching the government's attention. The government is monitoring quick commerce very closely. They are analyzing data from platforms like Zepto, Blinkit, Instamart, and Big Basket to look at how people are shopping and what people are buying. Now, I'm sure the first question in your mind is, why are they even doing this? See, that is because quick commerce has really exploded ever since the pandemic happened, and now it makes up almost 40% of online grocery sales in the country, according to the same ET source I told you about earlier. Now, the government is thinking about using this quick commerce data in order to help calculate the country's GDP and track economic growth. This data could give us a clearer picture of how people are spending their money in today's modern world where fast online shopping is almost becoming the norm of sorts. By the way, as a side note, if you want a deeper dive on this topic, do check out our episode which is titled Who Will Win the Quick Commerce Wars, which is linked in the description below. Now, back to the story. Another thing the government is curious about is dark stores. To explain it very simply to you, dark stores are basically very small warehouses that are set up in busy neighborhoods in order to make super fast deliveries possible. Recently, senior government officials sat down with an executive from one of the leading quick commerce companies in order to understand how these dark stores operate, especially in relation to India's foreign investment rules. Also, if you've been following the news lately, you might remember that Piyush Goyal recently made some very sharp comments about Amazon. He criticized the company for trying to find loopholes in India's foreign investment rules. Mr. Goyal said that such practices harm smaller companies and businesses and disrupt fair competition by giving bigger companies like Amazon a very bad unfair advantage. Now, with quick commerce booming so quickly, the government basically wants to ensure that companies like Zepto, Blinkit, etc. are not pulling out the same tricks from their hat. The government wants to watch very, very closely to see how these companies are setting up and also managing their dark stores in order to ensure that no one is playing around with the rules. Now, that's more or less about the government story. But while we are on the topic of quick commerce, I thought it'll be a great idea to update you all with some new movements happening in this space in a very few quick points. First, Flipkart recently launched its 10-minute delivery service called Minutes. It is now racing against Zepto, Instamart, and Blinkit. Flipkart plans to launch as many as 100 dark stores before the festive season begins this year, so they're extremely bullish about this space. Second, the ex-CEO of ClearTrip is launching a new venture that is focused on quick deliveries of premium products. Third, Zepto is trying something new with a feature called Super Saver. This is a service that is aimed at budget-conscious shoppers who like bulk shopping. Their hope is to push their average order value or AOV higher with this feature. Fourth, Myntra is also jumping into the quick commerce space with a 4-hour delivery service. This means quick commerce is now also making its way into categories like fashion, which have very high return rates. Next, Blinkit and Zepto are testing out quick returns and exchanges for fashion e-commerce. Their goal here is to make their customer experience smoother and more efficient. Next, Big Basket, which was known for its scheduled delivery slots, is now investing very heavily into quick commerce. They're planning to boost their dark store count from around 400 to 700 by FY 2025. Now, a big part of the reason why there is even more buzz around quick commerce right now is the upcoming festive season when sales are high across all categories. So all in all, with the kind of wild growth that quick commerce has seen lately, the lines between quick commerce and traditional e-commerce has started to blur out very quickly. However, quick commerce still has a long way to go in many categories. Let's talk about India's rising trade deficit and what it really means for us. See, India's trade deficit, which is the gap between our import and exports, recently widened to the highest level in 10 months. In August 2024, this deficit number hit around $30 billion US, which was driven primarily by a surge in gold imports and weakening exports. To give you a point of reference, economists had expected this trade deficit to be around $23 billion. So the 30 billion figure is almost one-third more than what experts had predicted. So in the first go, all of this might sound a little alarming, but it may not be as alarming as you think in reality. Let me explain this. See, the trade deficit that is being talked about here is specifically the merchandise trade deficit, which is only related to the trade of physical goods and does not include the trade of services. If services are considered, the overall trade situation completely changes because India has a $15 billion US trade surplus in services. But that said, there is something definitely happening here which is interesting to know and understand from an investor's perspective. So let me dive into the details of why gold imports have spiked, why overall exports are falling, and how the global economy is playing a critical role in shaping India's trade picture. I'll also try and explore what this trade deficit means for India's economic strategy moving forward and what solutions can be provided here. Let's start by first understanding why merchandise deficit is widening in the first place. See, the biggest driver of this deficit this time around is gold. Imports of gold surged to over 10 billion US dollars, which is 3 times the monthly average earlier this year. The reason for this spike is that there was a recent reduction in import duties of gold from 15% to 6%. There is also the festive season demand in India, which is coming up soon, and this is causing traders to stock up on large amounts of gold while the prices are low. But the good news here is that if August has seen a massive surge in gold imports, imports might moderate in the coming months. Another reason is China's economic slowdown. By this time, I'm sure all of us watching this know that China's economy is struggling. See, while China continues to produce goods at scale, its domestic consumption has slowed down significantly due to internal economic struggles. So a lot more of what China manufactures has to be sold outside of China now. This has led to an oversupply of goods, which China now exports at dirt cheap prices. These cheap Chinese goods are flooding the global markets, and it is making it very difficult for Indian manufacturers to compete. As a result, India's exports are struggling. The other reason is global supply chain disruptions. See, freight costs have skyrocketed because of global supply chain bottlenecks. A key reason for this is the disruption in the Red Sea and Suez Canal. Normally, this route serves as a shortcut between Asia, Europe, and the US, but disruptions have now forced ships to take a longer route around Africa, which has added significant costs and time to shipments, affecting Indian exporters. But now the question is, how can all of this be addressed? See, as you would already imagine, these are very, very complicated matters to handle. But still, let us take a look at a few ways that could help. First is expanding domestic production. Probably the most sustainable way for India to tackle this merchandise trade deficit is to strengthen domestic manufacturing. The government has already pushed initiatives like Make in India and the Production Linked Incentive or PLI scheme and has spent a lot on improving India's logistics infrastructure. Despite this, however, if we still have persistent difficulties in improving this deficit, it might be time to rethink our policies around manufacturing and foreign trade more holistically. The next potential solution is counterbalancing merchandise deficits with services surpluses. See, our balance of payments does not just depend on bringing down our deficit in manufacturing. We can look for other ways to bring in money to our country as well. Services, for instance, are India's strong suit. We have global capacity centers which export services across the entire world. The more we increase these service exports, the more easily we can tide over a high merchandise trade deficit. The next solution is drawing more foreign investments into India. See, another way more money can enter our country is through investments. Currently, the amount of foreign investments into India is falling despite many countries looking for alternatives to China. If we could somehow find a way to draw in more of this investment, it will bring two benefits to us. First, it will improve our balance of payment situation that we have today. And second, it will improve our manufacturing ecosystem in the long term. So in conclusion, while reading the news of India's widening trade deficit could seem alarming at first, it is important to keep the bigger picture in mind. Also, India's foreign reserves, which by the way are at the highest levels ever right now, provide a buffer against short-term shocks. But that said, the key to long-term stability in India is to improve our overall trade economy. The last severe balance of payments crisis we faced was in the 1990s, where the solution was to open up and liberalize the economy. Even though the current case is not severe as such, maybe there is a thing or two we can look to learn from the previous experiences. That's all the news and stories I have for you today. I hope you found this episode valuable and informative. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.